Hi everyone, and welcome to this video where I'm going to show you how to grow your retirement account 7 times bigger, 7 times faster, and with 7 times less risk through the Super Portfolio Rotation strategy. Now what does that mean to you as far as numbers are concerned? Well, I'm basically going to show you how to pocket as much as $1.9 million for every $10,000 in your retirement account. Now, if you're looking to accelerate your retirement account, I'm going to reveal to you how you can pocket as much as $1.9 million for every $10,000 in your account. And most investors would be thrilled with a 10% annual return every year. And 10% compounded over 20 years is nothing to sneeze at. It turns $10,000 into over $67,000. But that is a far cry from turning $10,000 into $1.9 million. But it's not as far away as many believe. The power of compounding returns is actually far greater than what most investors understand. And because of this, little attention is paid to investment strategies that can add another 2% or 5% or even 10% to their annual returns, because to increase your overall return from turning 10,000 into 67,000 to turning that same 10,000 into 1.9 million seems like a complete impossibility. And so investors turn to high risk, home run type trades, thinking this is the only way to really achieve wealth. But the good news is that pocketing 1.9 million for every 10,000 in your account is not as far away as you think. In this video, I'm going to show you a rock solid, proven strategy that has the ability to do exactly that. So then the question is, what does it take to pocket 1.9 million for every 10,000 in your account? Well, let's take a look at this a little bit closer. 10% annually compounds 10,000 into $67,000 in 20 years. 12% annually compounds 10,000 into over 96,000 in 20 years. So in other words, a 2% increase in your average annual return increases the overall return by 30% after 20 years. If you keep going, 15% annually compounds 10,000 into over $163,000 in 20 years. So a 5% increase in the overall average annual return increases your total return by 144% after 20 years. Let's keep going. 20% annually compounds 10,000 into over $383,000 in 20 years. So in other words, if you go from 10% annual returns to 20% annual returns, you're increasing your overall return after 20 years by a factor of 4.72 or 472% more in gains just by increasing your annual percentage return from 10% to 20% a year. Again, going further, 30% annually compounds $10,000 into over 1.9 million in 20 years. So an additional 20% annual return increases the overall profits by 2,735%. So what we're wanting to do is get to 30% average annual returns and then compound it. Now this is not super simple. It's not super easy. If it were, all of the hedge funds would be doing it. But what I do want you to see here is that every percentage point matters. Every percentage point matters. When you're talking about compounding, if you can increase your overall average annual return just by a little bit, you're looking at a significant compounded growth at the end of a longer period of time. So our goal is to average 30% annually. And that 30% annually compounds 10,000 and over 1.9 million in 20 years. Very unrealistic goal with the buy and hold. The buy and hold will not achieve this goal. It's virtually impossible. Since 2000, the total compounded return on a $10,000 account in SPY was only $46,722, or an annualized growth rate of just 6.72%. That's it. So to jump from a 6.72% annual return in a major stock index to 30% over a long period of time is just, it's not going to happen. We need to do better than this. We need to do a lot better than this. And the super portfolio rotation strategy is a powerful approach to achieving significantly above average returns with substantially lower risks. In 2000, major stock indexes were up about 20%. However, in the S&P 500, the entirety of that 20% move could be attributed to just 25 different stocks. In other words, if you did not have those 25 stocks in your portfolio and instead had some combination of the remaining 475 stocks in the index, you likely didn't come anywhere close to generating the 20% returns that were achieved that year. And most years are very similar. The majority of the returns of an index are attributed to a small group of stocks. And the first secret to achieving above average annual returns is to have a group of rock solid, proven stocks that have consistently outperformed the S&P 500 year in and year out. That is the absolute beginning point of being able to start to increase your overall average return. So rather than try and hit the long shot home run in some pharmaceutical company or some high-tech company or risky crypto trade, we're going to invest in math. We will invest in rock solid, proven stocks and then let the compounding create our wealth. And I'm going to show you a group of just 10 stocks from a pool of over 150 stocks that we have painstakingly researched and settled on as our super portfolio group of stocks. And this is the foundation from which we will build on to target achieving the 30% annual returns. This group of 10 stocks are at the bottom of the stocks in our group of 150 total stocks. So I'm going to reveal to you 10 stocks that are at the bottom of our 150 total stocks in our group. So the first one that I'm going to point out is a company called ATR. And in fact, we just recently invested in ATR. Our signal was just recently hit in ATR. So we are now long ATR as one of our stocks right now. And if you invested $10,000 into ATR in the beginning of 2000, that $10,000 today would be worth $138,287. That's an annual rate of return of 11.71%. It's a total increase of 1,282% on your portfolio and a total profit of $128,287. Now this is at the bottom, and this absolutely blows, this stock has blown the S&P out of the water over the last 20 to 25 years. This is one of the bottom ones in our group of stocks that we use. Here's another one, EQT. And if you would have invested $10,000 in EQT, that $10,000 would have grown into $132,000 over the last 23 years. Again, an annual rate return of 11.51%. Here's another one. Many of you will recognize this one, most of you. This is PepsiCo. If you would have invested in Pepsi or PepsiCo in January of 2000, that $10,000 would be worth $91,487 today. Here's the next one, the Royal Bank of Canada. And in this one, if you would have invested $10,000, it would have turned into $179,000. That's an annual rate of return of almost 13%. And again, these are in the bottom part of our group of stocks. Here's another one that we recently purchased. Again, we're now invested in this one as well. It's UHT, and if you would have invested in UHT back in 2000, your $10,000 would be worth $142,000 today. Here's another one, Abbott Laboratories. Turns $10,000 into $113,000. You can see all of these are at 10% or above annual returns. Here's Hormel Foods, HRL, And this one would have turned 10,000 into $115,000 for an annualized rate of return of about 10.8%. Here's one, SO Company, and this is actually one of my favorite ones because it's one of the first ones that I really started to invest in years ago when I first started looking for a group of stocks. And this one goes back to almost like 1981, and it is up like 80% of the time. So go back to 1981, the stock has increased 80% of those years, which is phenomenal. And if you would have invested 10,000 back in 2000, $10,000 back in the year 2000, your $10,000 would have grown to $214,000. That's an annual rate of return of almost 14%. And we're almost getting to the end here of this group of 10. Here's another one, FISV. FISV, if you would have invested 10,000 back in 2000, you would have turned it into $190,000. Here are a few that are in the top tier of our group of stocks. And I'm not going to reveal these, but here's one. If you would have invested in this stock in the year 2000, $10,000 would have turned into $12 million. That's an annual rate of return of 35%. So you can see there's a huge difference when you start really increasing the average annual return of the stock that you're getting involved with. And so this one is a huge one, but it's not even our biggest one. Our biggest one, are you ready for this? Is this one. And if you would have invested 25,000 into this stock, you're looking at a return of 31 million after just 23 years. So again, this is about a 35% rate. So if you would have invested 10,000, it would have been about 12 million again, a little over 12 million again. So those are a couple of our best stocks that are in the group. And then there's several that you'll recognize. This is one of the better ones, and this is Starbucks. If you would have invested 10,000 in Starbucks in 2000, 401 turned 10,000 into 401,000. That's 16.85%. And again, we can go on and on and on. And each of these is investing 10,000 in January of 2000, or as you can see in March of 2001, which is when this particular stock came on the board. And we just have 18%, 19%, 21%, 19, 17, 17, 19, 26%, right, on this one. And that turns 10,000 into 1.3 million. We're almost at the 1.9 million with this one right here alone. And then you get here's 16, 20, 21, 20, 19, 18, and 20. You get the idea. We're starting with a significant group of stocks. And $25,000 invested at 25% annually reaches 1.1 million in just 17 years. So if you're looking to become a million, you don't have to do 30%. You don't necessarily have to turn 10,000 into 1.9 million to do really well. You can average 25% annual returns on a $25,000 account and still be retired with over $1 million in just 17 years. And that's the average of what we're seeing here. So most of these stocks are not obvious. So you've noticed Starbucks, you'll notice PepsiCo, but most of them are not obvious. And in fact, you wouldn't recognize most of them. But here are a couple that didn't make the list that might surprise you. First of all, Walmart did not make the list, and you can see why. It's a meager annual return. Yeah, sure, it's a stalwart. It's going to be around for years and years to come, but it's just not a great long-term investment. Here's BAC, Bank of America, not a great long-term investment. And here's one that didn't make the list that has been a great investment, but it's too risky. And so we have a stringent set of criteria that each stock has to meet in order for it to reach our super portfolio group of stocks. Part of it is consistency, part of it is the ability to generate above average returns, and part of it is the risk analysis. So Tesla is just too risky. And even though it could produce significant gains, it's also too risky for a portfolio, so it's not included. Then you have Verizon, doesn't produce very good returns at all. And then look at this, Ford Motor Company actually is a horrible long-term investment, or at least it has been for the last 20 years. So in other words, our first step to give you a solid probability of achieving extraordinary returns that compound into millions is to start with a rock-solid, proven group of stocks to invest in. This is the foundation of the super portfolio rotation, and it is built on solid ground. So then that brings in the next step in this whole process, and the next step is the timing. And I've been trading since 1987, and I've seen, tested, and traded pretty much everything under the sun. So suffice it to say that I've narrowed down what I believe to be 4 basic conditions that need to be present to give you the highest probability of yielding the most efficient return in any given stock. And in short, I take the stocks in the super portfolio group and I look for these 4 conditions to exist. And if all 4 exist, I buy. It's as simple as that. And if just one of these 4 conditions ceases to exist, then I start to exit. I look for an exit point. And what do these 4 conditions do to the stocks that are in our super portfolio? We'll take ATR as an example. If you recall ATR, if you invested $10,000 in January 2000, it turned that $10,000 into $138,000 over the course of 23 years. That's an average annual rate of return of 11.71%. But if you buy ATR only when the 4 conditions exist, when the super portfolio rotation 4 conditions exist, you're looking at a win rate of 88% over the last 26 years, and an average profit per trade of $95. Now this is based on investing $1,000 into the trade. So you're looking at about a 9.5% return. But here's what I want you to notice. We're holding on to the trade on average for only 70 days. That's it, 70 days. So we're making basically what this is made, almost the entire 11.7% in 70 days. This comes to a 35.4% non-compounded annualized return. Again, holding on for only about 25% of the year, not even that. So this is a efficient way of controlling your risk exposure in any given stock. We're not invested in these stocks year-round. We're invested while the 4 conditions exist, and that improves our efficiency substantially. Here's another example in EQT. If you had invested $10,000 in EQT January 2000, that turns in $132,000. But if you only invest in EQT when the SPR 4 conditions exist, we're looking at a win rate of about 76% over the last 21 years, and an average profit per trade on $1,000 invested is at 16.1%, or $161 return on $1,000 invested. So that's a 16.1% return. Notice, what is the annualized return? It's 11.51. So we actually improved the annual return, but because we're only holding on to the trade for an average of 54 days, that turns that into an 81% non-compounded annualized return. Okay, you can start to see the efficiency here. Now, we bought EQT on March 9th of this year and exited on June 15th for a gain of 24%, 24.8% to be exact, annualizing out to 92.37%. So you can see that this year's trade fell right in line with what we've seen over the last 20 to 25 25 years. Again, here's Starbucks. Again, this is one of the better ones. 16.85% annualized return turns 10,000 into 401,000 if you would have invested in January of 2000. Here is only buying SBUX when the super portfolio rotation 4 conditions exist. Winning percent is at 84% over the last 25 years, and the average profit on $1,000 invested is $222. That's 22%. It's 22% return, and holding on to the trade on average for about a little more than half of the year. And so that comes into a 31% non-compounded annualized return. Again, here's that 30% again, right? We need 30% over the year. And if you take a look at a group of our, this is just a random sample group of SPR strategy stocks, you're going to see the winning percentages in blue and the average annualized returns, because we're not holding on to the stock for the entire year, is in orange. And you can see here we're averaging about 30% annualized returns on these stocks. So we're hitting our target there, and we have a pretty high win rate with these over the last 20 to 25 years. So when stocks move, annualized returns increase substantially. In other words, when the market makes a move higher, obviously that's when most of the returns are captured in the stocks. So I want to show you the trades that we rotated out of in the month of November. These are actual trades, not hypothetical. On the left side, we have a return on risk that's 12.18%. That's not annually. That's just simply the return on the risk that we put in there. So if that stock would have gone to zero, obviously we would have lost 100%, but it did not go to zero. We exited at a profit, and we made 12% on our risk. However, if you annualize that out, because of the time that it took to make this 12% was a very short period of time, it annualizes out to 143%. Here, we didn't make a whole lot on this one, 7.36%, but because of how fast it made that 7.36%, it annualized out to 268% annualized return. Here's a 5.37 annualized out to about 122% annualized return. Here's almost 12% at almost 200% annualized return. Here's again almost 12%, but this one exited even quicker, so that means that annualized out to 303%. Here's one at 8.41% at 39% annualized return, 131% annualized return, and again 180% annualized return. So during the month of November, stocks moved up, and we were able to rotate out of several of our stocks for significant annualized returns. So we can beat what you see, the average annualized return of 30%. But that brings in the next major component to this process, to the super portfolio rotation strategy, and that is what I call rotation stacking. This is a very important piece to this puzzle, and it is very powerful. And this is our third secret to achieving above average returns that will compound into millions. Rotation stacking. And this is how it works. I'm going to give you a really simple hypothetical example to explain the power of this process. So it goes something like this. Let's say in January you pick a really good stock, you hold it for 3 months, and you make 10% on that stock. Well, at that point, you go ahead and you exit, you take your profit for 10%, and then you pick another stock that looks like it's about to make a big move. And so in April, you pick that stock, you hold it for 3 months, and you gain 10%. Well, then you go ahead and you exit that one, and then in July, you pick another stock, and it looks like it's about to move, and lo and behold, it moves up, and you make about another 10% return on that stock. And then you do the same thing in October. You exit out of the July stock, you get into the October stock, you hold it for about 3 months, and you gain 10%. Well, this, all of a sudden, even though this January stock may have made 15% by the end of the year, Maybe the April stock made 20% by the end of the year. Maybe the July stock only made 10%, et cetera, et cetera, right? While each one of these individual stocks probably didn't make 40%. But because you were able to rotate out and into better stocks, you didn't need a single stock to make 40%. You just needed a quick 10% in about 3 months from any given stock. And so at the end of the year, 10,000 grows into $14,641. That's a 46% annualized return. 46%. And what do we need to grow 10,000 into 1.9 million? We need 30%. So this rotation and applying this rotation strategy to an already really good group of stocks is a really powerful combination and way to invest in the stock market. Now, I want to point something out here. You'll notice that if I have $10,000 in a stock and it makes 10%, I now have $11,000. Right? So if I invest 10,000 and it makes 10%, I make $1,000. I now have $11,000. Well, I'm now going to invest that $11,000 into the April stock, not $10,000. And so I actually make 10% on $11,000 investment and not a $10,000 investment. And what that does is that increases the overall return by $641. So instead of making $4,000 in gains, I am using intra-year compounding. So it's another major benefit to the rotation stacking, is because you can compound it intra-year, and it adds another 6.4% return on your overall gain. So 20% return turns $10,000 into $383,375 after 20 years. But quarterly compounding at 5% per quarter. Okay, so if you can only average 20% annual returns, but you're able to compound that 20% every quarter, so you make 5% per quarter, and you compound it 5% per quarter, that actually compounds into $495,000 after 20 years. You go from 383 to 495 just by being able to compound quarterly. It is very powerful. That creates an additional 29% overall increase in your overall return after 20 years. That is nothing to sneeze at. 20% return turns $50,000 into 1.9 million after 20 years by rotation stacking. Quarterly compounding at 5% per quarter compounds into $2,478,000 after 20 years. Right? So if you take the same 50,000, you make 20% on 50,000, it goes to 1.9 million. But if you're able to quarterly compound that 20%, so it's 5% per quarter, you're looking at increasing that by about $550,000 after 20 years. It's nothing to sneeze at. Again, it creates an additional 29%. So 40% annual gains compounded quarterly. Look at this. In 5 years, 10,000 grows into 67,000. 10 years, that 10,000 grows into 452,000. 15 years, that 10,000 grows into 3.4 million, and in 20 years, that 10,000 grows into $20 million if you're able to average 10% per stock every 3 months and then rotate it and use intra-year compounding or quarterly compounding. This is massive. This is incredibly powerful in increasing your overall net return, and very, very few investors use this powerful concept. But let's say, it doesn't work out like that. Let's say the first stock you make 10%, the second stock you lose 3%. Then the third stock you make 14%, and the third stock you make 14%, and the fourth stock you make 12%. Well, at the end of the year, you've still grown $10,000 into $13,251. So it's not anything to sneeze at. In this same scenario, you're looking at 5 years turning 10,000 into 40,000. 10 years turns 10,000 into 167,000. Jump down to 20 years. With this scenario, if this is the scenario, every year for 20 years, it turns 10,000 into 2.79 million. And 100,000, if you invest $100,000, that grows into 408,000 in 5 years and 27.9 million in 20 years. Again, that's with this scenario, where after the first 6 months, you're only up 4%. And then you have a couple of good stocks, right? So a lot of different ways to do it, but everyone should consider starting this approach right now. There's no reason why everyone should not, who's invested in stocks or considering investing in stocks, should not absolutely put this powerful concept to work for them. In essence, overall, again, this is for illustrative purposes only. This is a hypothetical. But every 5 years, your money grows by a factor of about 4 times in this scenario. Every 5 years, you grow your money by about 4 times in this scenario. It is extremely powerful. So we don't want to pick one stock, obviously, and put 100% of our capital in on that one stock in each rotation, right? We have a group of stocks. That's why we have about 150 stellar stocks that we rotate throughout the year. And that is to give us significant diversification so that we don't have one stock that goes bankrupt, for example. And even these stellar stocks, they're not immune from bankruptcy. Things change. I mean, the pandemic turned a couple of really solid stocks for 20 years. It just changed the marketplace, and they weren't able to survive. So we don't want to put all our eggs in that basket. And we don't want to rotate exactly like this. We want the stocks to dictate when we rotate in and out of them. And that's the first 3 major components to this incredible approach. And there is one last major component that I do want to cover, but I'm not going to cover it just yet. And it is one that will give you the most confidence to be aggressive in your approach, enabling you to put yourself in a position to achieve 25%, 30%, even 35% returns in mediocre performing years. And in addition, you'll never worry about a stock market crash again. So this is a really important major component to this. But before I get to that, I do want to show you how you can follow the trades with the Super Portfolio Rotation. First of all, you can call Spring at 918-203-7547 and she will get your spot reserved. Or you can just click on the order button on the link that you are watching this video on. But here's what you get with the Super Portfolio Rotation. Number one, you get exact entry and exit alerts. Every week we come out with a weekly report. It gives you an update on where all of our open positions are, on any trades that we've closed out, and any new signals. They're exact. They're very, very easy to follow. There's no issue. All of these, every signal that you see come out, we are taking. So everything that you see is actual fills, not hypothetical. Okay, next you'll also get a Super Portfolio Rotation monthly newsletter, and you'll also have access to a quarterly Super Portfolio Rotation recap webinar where you can come in and ask any questions if you have them. So with the weekly alerts, just kind of show you this one here. This was in MSM, and we had a weekly alert to buy it at 92, which was filled, by the way. We bought at 92, and based on a $50,000 portfolio on a conservative allocation of 1.5%, we did 8 shares on a $50,000 portfolio. And you'll see here's the target 102, and right now the price is at 97.33. So as of right now, this alert, which was filled at 92, is making about 6%. And so you'll see this is really easy to follow. Buy the MSM stock at 92 on a limit, and you can do 8 shares. You can do however many shares you want. This is just based on allocating 1.5% of the $50,000 portfolio, so that comes out to 8 shares. I talk more about that in the video. Nevertheless, this is how the alerts come. They're very easy to follow. Here's a recent report, weekly report, where we show the closed positions for 2023. And as of the time of this video, the winners were there were 79 winners out of a total of 82 trades. We've only closed out 3 losses. Now we do have more open position. We do have some losses. And one thing that you're going to find out is we're not into timing the bottom. We're not trying to pick the bottom, and we're not trying to pick the top. So it's very important for you to understand that. But we have a few open position losses as well. Nevertheless, the closed percentage return on a very conservative allocation of 1.5% was 15.09% so far. Plus the total, or excuse me, the closed positions in November totaled $608. Again, on a $50,000 account, that's about it's about a little over 0.5% on closed. And our total open position profit right now is at like almost 2%. This is shows you the closed trades in November. I'm revealing some of the closed trades that we had in November. Microsoft, again, you can see here 143% annualized return, 268%, 122, 198, 303, 40%, 131%, and 180%. All of these are actual fills. They're not hypothetical, and these are the only closed trades. We didn't have any other closed, so I'm not just cherry picking. These are all of the closed trades from November, and you can see here substantial overall annualized returns. Now, with the monthly newsletter, basically you're going to get an open position. We cover the open positions. We talk about possible rotations for the upcoming month, and we start listing those stocks and kind of giving you a heads up. We also provide some commentary, analysis, some general observations about individual stocks, entire sectors, and the overall market in general, for that matter, and anything that might be relative to the super portfolio rotation. Then in the quarterly recap, we discuss everything: the performance, our positions, our outlook, following quarter, and we answer any and all questions. And the pricing, this is limited time, very special pricing. You can get involved with the SPR for only $297 a quarter. You're better off going with the 2-year. You're better off going with the 2-year. We want to encourage a long-term commitment because this is just a really powerful approach overall, and it really takes some time to start to see the effects of this approach. And so you're better off just going with the 2 years. We want to reward those that commit, and instead of paying an average of $99 a month for the quarterly, you're going to be paying on average $62 a month. But there's an even bigger bonus that exists for those who commit, and that is after the 2 years, you're not going to be paying $1,497 for the next 2 years. You're going to be grandfathered into a yearly subscription to of a continuing subscription of only $297 a year for life. So again, we're wanting to reward those who commit to a long term and give you this very valuable approach and signals, weekly updates, monthly reports, and quarterly webinars for just $297 a year thereafter. This is very limited to you. So once this goes away, you won't see it again. So be able to grandfather yourself in, get into the 2 years now, and then you'll be grandfathered into $297 a year. Thereafter, that comes to only $25 a month thereafter. So you'll have lifelong access to this for very, very reasonable subscription price. All right, so let's get to the one last major component to the super portfolio rotation approach. Very, very important. The question begs, what if stocks crash? What if stocks crash? Well, if you're investing a very conservative 1.5% of your account to any given signal, during 2023, which it is very conservative, you would have never been fully invested. Most of the time you wouldn't have been anywhere close to being fully invested. Yet, despite the fact that we have never been fully invested, we've still produced a 15% closed trade return. And add that to the open and add the dividends that we've received from that, and you're looking at about 18% return on a $50,000 account without being exposed to $50,000 of risk. Right? So there's room to be more aggressive. And in fact, you can have approximately 67 open positions at any given time out of the 150 stocks that we rotate in and out throughout the year before you finally become fully positioned. So there's lots of room to be a little bit more aggressive. But let's say we have $40,000 invested in a $50,000 account. That means that we're 80% invested, and then stocks crash. If stocks crash at that point, let's say they crash 25%, we'll drop 10,000. We'll go from 50,000 to about 40,000, right? But that's actually saving about $2,000, right? Because in other words, we have a bit of a buffer. It's not a huge buffer, but it is a bit of a buffer. And most of the time we're not even invested, with this allocation, we're not even invested in $40,000. Every now and again we'll go over 40,000, but most of the time we're not even invested that much with this percentage allocation. So if stocks crash, you're getting the return with a fraction of the risk right off the bat. The question is, how can you be more aggressive? Because on the flip side of that, we also have a lower probability of realizing a larger average annual return if stocks do well, because we're not going to be fully invested, right? So we want to try and be fully invested, but again, at the same time, we don't want to be, we don't want to have a complete exposure to a stock market crash. And remember, every percentage point counts, right? Every percentage point counts. So if I can show you how to be fully invested while never risking a market crash again, you will have a far greater chance of increasing your overall average annual return substantially. Let me give you a couple of examples. Okay, so remember, every percentage point matters. Every percentage point matters. $100,000 compounded at 10% annually after 20 years is represented by the blue line. If you can double that, look at this, at 20% annual return, you're looking at almost $4 million. Instead of about 600, 700,000, you're looking at 4 million. That's a huge difference. So every percentage point matters. Well, look at this. This is missing the major downturns. In other words, when the market crashes or when a bear market occurs, you're not necessarily realizing all of the losses coming from that drop in the overall stock market. And believe me, it doesn't matter if we have the greatest group of stocks in the world. In a crash, it pulls down most of the stocks. It may not be by as much, but it will pull them down. And so the SPR will lose money in a crash. No question about it. So the question is, how can you protect yourself from that potential loss so that when the market moves down, your account value does not move down equally? Maybe it moves down a little bit. I'm going to show you something in a minute where it can actually move up. Nevertheless, then after the move is done and stocks begin to recover, you participate in that recovery as well. This is a major component to being able to achieve a long-term average annual return that is big enough to create millions in profits on a small account. So in other words, in this one, instead of making from 1997 to about 2012 130% with the buy and hold, by being able to drop or hedge against a market move so that your account balance remains fairly stable, you're able to increase that to 270%. That's an 8.6% annual return versus an 18% annual return just by missing the corrections during this time period, as an example. So $1,000 invested in the S&P 500 in 1995, suffering through the market corrections, turns into about $10,000. But if you're able to avoid the market corrections, that same $1,000, it turns into about $30,000. Again, avoiding the correction, avoiding the major market setbacks is just tremendously powerful. So as an added bonus, I will be providing free access to a video entitled How to Hedge Any Stock Portfolio. And when you implement one of my powerful, simple hedging strategies, not only can you avoid significant losses during a market crash, you could actually make money. And here's how it works. This is an example of a hedging position that I had on. The market was trading around 432 at the time. And you'll notice if the market moved down to about 320, this thing makes about $18,000. All right, so if the market was trading about 432 and it moves down to about 321, you're looking at a loss there of about $11,200. Okay, because the entire market is worth 43,000, a little over 43,000. If it drops to 321, it's worth about 32,000. So you're looking at about a little over $11,000 drop. Yet on the same move, your hedge makes 18,000. Your hedge, this is a simple trade that if stocks move down will begin to make money. Now, if you're down 11,000 and your hedge is up 18,000, guess what? You didn't just maintain account stability, you actually made money on the crash. Now, there are different hedges. You can be less aggressive or more aggressive with the hedge, so you do make money, or maybe that you do just keep fairly even Steven with the market crash if the market does crash. You can actually adjust this however you want to do it. But I wanted to point that out, that the hedge is very, very powerful. This is one of a kind video. And I'm going to show you how to create low-cost, high-reward hedge positions that will safeguard you from a significant drop in stocks and or a significant drop in the super portfolio rotation approach. This video will also show you how to reap the rewards on the way down and open up your portfolio to regain on the way back up. In other words, remember, if you have your hedge in place and your account balance remains fairly stable during this drop, your stocks lost money. And on the move up, if you have that same hedge on, you're now losing money on your hedge, but you're regaining your stocks. Well, I'm going to show you how to rotate your hedge so that as the market moves down, you're rotating your hedge so that if the market starts moving back up at several of these points here, you will not be losing the entire value of your hedge, but you will be gaining value of your stocks on the way back up. Very, very powerful. So this is going to show you how to do both hedge on the way down and regain on the way back up. This is such a powerful concept. You're almost going to wish that stocks would crash. We don't want to wish that stocks crash, but that's how powerful this hedging approach is. This video is absolute gold, and it is yours as a bonus, absolutely free, as a subscriber to the Super Portfolio Rotation. So when you understand how to properly hedge your stock portfolio, you can be fully invested, knowing that the downside is protected, giving you maximum efficiency to compound your money. You'll never lose sleep over your investments again when you have this whole approach in place. You'll maximize your potential compounded growth. You'll potentially make money even if stocks crash. You can participate in the recovery when stocks begin to recover by rotating your hedge. You can invest with confidence, and you can create substantially better consistency in your retirement account or any investment account. Now, I want to show you this. When stocks crash, if you were to get into the stock market in middle of 2000 and the stocks crashed and then they recovered and then they crashed it again in 2008 during that housing bubble and then they recovered again, you finally reach back that point at new highs when you first invested in 2013. 13 years. So this is really important if we start to see a bear market coming in. Now, during an all-out crash, again, SPR will lose money. So you want to be hedged, period. Even though the probability is that the SPR will lose less than the overall stock market. For example, stocks recently slid about 10%. SPR only slid about 5%. And I had a hedge on, and so I was able to make that entire amount back. But the SPR holdings still only slid about 5% when stocks, the S&P actually fell about 10% during that time period. So this bonus video is super important. If you have any stock portfolio of any kind, you're going to want to watch this video because this is going to help you no matter what. And remember, every percentage point counts. And the super portfolio rotation is specifically designed to give you the most efficient stock trades possible so that you can increase your overall return and compound into millions. And then it shows you how to efficiently and effectively hedge against a market downturn. So maybe you start a college fund for your kids with this approach, or your grandkids, or maybe you just allocate $20,000 to $30,000 of your entire portfolio, retirement portfolio, into this account. Regardless of what it is, this is extremely important that you get involved in some way, shape, or format with these concepts, even if it's not with the SPR. These concepts are just incredibly important and incredibly powerful. Or maybe you have $1 million in market exposure, at which point you definitely want to be hedged, number one. And number two, you want to make sure that that exposure is as smart and as efficient as it can be. And in today's economic climate where unexpected world events can wipe out investments, you can't afford not to subscribe to the Super Portfolio Rotation. So again, $20,000 allocated to SPR at 25% annual returns, if we're able to achieve 25% annual returns, grows to $1.7 million after 20 years. If you have $100,000 invested in a conventional 7% annual return type investment, that only grows to $386,000 after 20 years. Okay, so $20,000 is 1/5 of $100,000, and $1.7 million is 5 times bigger than what you see the growth. In other words, 1/5 of the investment risk in SPR potentially grows almost 5 times bigger than the conventional investment that starts with 5 times more capital. That's how important and powerful this approach is. You cannot afford to not allocate something to SPR. Again, this is a limited time offer, $297 a quarter. Click on the subscribe button now. You'll get access to the video, to the weekly alerts, to the monthly newsletter, and the quarterly webinar. Limited time. Get now. And again, if you subscribe for 2 years, you'll never pay more than $297 a year thereafter as a reward for your commitment. Call Spring at 918-203-7547 or click on the order button, and I will see you in the next SPR webinar.